Trowbridge Law Group, another episode on our YouTube channel, and I hope you're subscribing to our YouTube channel and get all of our good information. This particular episode is just following along with three I've done here recently because it's tax time. And so this episode has something to do with the tax law and filing tax returns. And this episode is understanding capital account. Now, capital account is really something that the accountant does. In LLC, we're going to talk about capital accounts in LLCs. The LLC has a capital account, and each individual investor has a capital account. And you're interested in your capital account because one of the things that I know happens is people invest, let's say, $100,000 in an LLC. And at the end of the year, they get their first K1. And on the top of the K1, it tells them that their capital account is $80,000. And they start calling. When I was a syndicator, that was the number one reason for calls during the year, people not understanding what was happening in their capital account. So I made a point of putting together an article and sending it out to my investors prior to the first year. Once we saw the first year, everyone understands how it goes, but it's a first year issue with many investors. So I'm going to talk about it right now, and we're going to see how our capital account works. You ready? Here we go. Understanding capital accounts for investors in LLCs. So what does a capital account do? It tracks the capital in an LLC. It's an IRS set of rules. It's kind of not intuitive, but it shows up on your K1. Everyone's capital account starts at zero. And then it adjusts. There are four ways a capital account can adjust. It can go up through your capital contribution, which adds to your capital account. So when you send the syndicator your $100,000 to start with, your capital account goes up. It goes down when you get cash distributions. So at the end of the year, when the syndicator sends you $10,000, your capital account goes down. You see what it's doing? It's measuring what do you have in the offering on a somewhat of a cash basis. Cash going in increases your capital account. Cash going out decreases your capital account. And then it gets a little hairier here, where if you report taxable income, that's going to increase your capital account, because when you report taxable income, you're going to have to write a check. So you're going to have more invested in this investment. And then taxable losses reduce your capital account. In theory, if you have a taxable loss and you can take it, you're going to get a refund check. So that's something coming back to you in your capital account. And when it's all said and done, it has to end at zero. The company has a capital account starting at zero, ending at zero. The investor's capital account has to start at zero and end at zero. You with me? Let's go forward. Okay. So here's the results of a property. We have $1 million net operating income minus expenses. We have $600,000 of interest payments this year, and depreciation of $600,000. And we have taxable loss, and we have cash to distribute. So this is supposedly the best of both worlds. We get positive cash flow and we get a taxable loss. That's great. Now, our investor is a 25% owner of this LLC with $500,000 as the initial investment. So let's track their capital account this year. It was zero, right? Then they put $500,000 in. That takes you up to $500,000. Then their share of the taxable loss, which is 25% of the 200, is $50,000. That takes their capital account down. The cash distributed, $50,000, takes their capital account down. So at the end of the year, they have $400,000 in their capital account, and that's what shows up on the top of their K1. So they wonder how come their $500,000 is now only worth $400,000. Well, it's just capital accounting. It really doesn't mean anything. You got $50,000 of cash in your pocket, and you had $50,000 worth of losses. As you might have seen in the other videos I've done, if we're talking about depreciation and passive income, we don't know if we can use that loss, but that's not important in the capital account. It's just accounted for as if we can use it. So that's what happens there, and this happens every single year. So what's going to happen over time? Generally, your capital account is going to go below zero. You're going to get enough taxable losses, enough write-off, and enough cash distribution that over time, your capital account goes below zero. Now, unfortunately, it has to end at zero. So what happens? Well, at the time of the sale, you're going to get cash distributed to you. That may very well take you back to zero. But if it doesn't, there is another thing that will increase your capital account, taking you back to zero, and that is reporting taxable income. Let's see. Here's the capital account at sale. The sale price is $3 million. This is the net sale price is $3 million. The balance of the mortgage is $1 million. The sales proceeds $2 million, and there's $2 million to distribute. Well, here we go. Here's our individual investor. At this time, in my example, the individual investor has a negative capital account of $400,000. The property produced losses this year, $50,000. The investor is going to get $500,000 of the sales proceeds allocated to them. So what's happening? We start with 400 in the hole. We go another 400 in the hole, and then we go another 500 in the hole, because all these things are reducing our capital account. So we end up at $950,000 fully accounting for the life of the property. The only problem is we have to end up with a zero capital account. So what happens? We have to go from 950 negative to zero. The way you do that is you get allocated taxable income, taking your capital account back to zero. So this investor would get $950,000 of taxable income allocated to them. And then we'd have to decide, is it cost recovery, is it capital gain? That's not important in the capital account. It's just we have to have a closing entry of $950,000. Now, once again, the LLC has the same thing. The LLC has a running total of their capital account. They do everything. We get down to the bottom. The LLC has to report income to get it up to zero, to get the capital account up to zero. And the LLC doesn't report, so what doesn't pay any taxes, doesn't really report income. It allocates that final entry to all of the investors. And this investor is going to get $950,000 allocated to them as their share. So that's what the capital account does. And we only pay attention to it once a year when we get our K1s. People misunderstand capital account. They think that all cash distributions are taxable. They think that all tax losses are usable. All that, none of that really applies to a capital account. We're just simply measuring what do you have in your investment. You start with 500 in this case. You start with zero, you go up to 500. Through the years, it goes lower and lower and lower. You get some cash out, and then you have to have one other entry to bring you back to zero. So that's the capital account. Something you should probably discuss with your with the CPA. You should look at the projections in the private placement memorandum to see what's going to be happening in a capital account. Talk to your sponsor about that, how that's going to affect you. So that's our presentation here on our YouTube channel of understanding your capital account. I'm Gene Trowbridge, Trowbridge Law Group. Contact us at our website. You can sign up for a half-hour consultation with me, which is free. You can call me direct. You can send me an email. Love to talk to you, and hope that you found this value and look at some of our other YouTube presentations and subscribe to our YouTube channel. Thank you.